Well, good afternoon. We're ready to get started with the CFA Institute Research Challenge. This is the 6th annual local research challenge for Colorado and Wyoming region. I'd like to congratulate all the teams that made it that far and being finalists of the local challenge. I know some teams couldn't be here, and so you should be proud to go through the research for the last 5 months and for your teamwork, dedication, and being a finalist of the local challenge. My name is Ivan Stichkari. I'm a organizer of the research challenge, and Benjamin Lean, he is running late, he will be here. We have Oksana Donchila, she is the media and PR coordinator for the research challenge. The subject company of the research challenge this year is Charles Schwab. It's headquartered in San Francisco, but has significant presence in Colorado. It's 37.7 billion market cap, financial services titan that employs more than 14,000 employees. We would like to especially thank Bill Quinn, the Senior Vice President and Treasurer of Charles Schwab, and his team for all the time for a Q&A session and letting the students to visit facilities of Charles Schwab earlier in the competition. And this is the agenda for tonight's event. After this, I'll introduce the judges. Then we'll have a rules review. Then the teams will present. Each team will have 10 minutes for presentation and 10 minutes for Q&A. We'll have an intermission probably after 3 teams are done. Then we'll break for the restrooms or food, and then we'll have the next 3 teams to present. Total, we have 6 teams tonight. After all the presentations are over, we'll have photographs taken of individual teams and of everybody who participated tonight. And then we'll have a ceremony for the winning team. All the participants will receive certificates for participation. And on this note, let me introduce today's judges. Today we have 4 really star judges. We have Bill Quinn, CFA, who is the Senior Vice President and Treasurer of Charles Schwab. Bill Quinn has served as a Schwab Treasurer since he joined the firm in 2010. During the financial crisis, he was appointed as Chief Risk Officer for Fannie Mae Capital Markets Group. Prior to that, he had roles in fixed income, portfolio management, and asset liability management consulting. He's a CFA charter holder and has bachelor's and master's degree from Sloan School at MIT. The second judge, we have Tom Riley, CFA. He is currently a president of CFA Society Colorado. He has been an active volunteer with the society since he received his charter in 2009. He has been a board member for the prior 4 years. Tom is a portfolio manager at Northern Trust in Denver. He has worked in wealth management and asset management for nearly 20 years. He received bachelor's of Science from University of Colorado and MBA from University of Denver. The third judge is Kathy Burgett. She is a charter holder. She has experience as a sell-side equity analyst for Wells Fargo, Credit Suisse, Deutsche Bank, covering technology companies in New York and Silicon Valley. Kathy was a banker, credit and financial analyst at JP Morgan and Westpac, where she managed a loan portfolio. She also served as a CFO at Boulder startup pursuing sustainable transport. She has a bachelor's degree in accounting, MBA in finance, and CFA charter. Our last but not least judge is Daniel Katz, CFA. Daniel is born in Denver. He spent the majority of his life in Colorado. After attending University of Colorado Boulder, he received a degree in economics. At the CU Boulder, he received degrees in economics and English. Daniel pursued a career in financial industry. After holding positions at a regional firm and later at Morgan Stanley, Daniel helped start Denver Private Wealth Management, a registered investment advisory firm in Denver. As a partner at Denver Private Wealth Management, Daniel serves as a portfolio manager for the firm's clients. He became a charter holder in 2012 while working at Morgan Stanley. Daniel pursued the CFA designation to learn how to analyze securities, manage portfolios, while adhering to the strict code of ethics. And he is also on the board of the CFA Society Colorado. So we truly have a very experienced panel of judges that cannot wait to ask students really interesting and tough questions. Next, we will review the rules. So tonight we will have 6 teams. Each team will give an investment recommendation on Charles Schwab. They will have 10 minutes for the presentation, and once the team reaches 9-minute mark, we'll have Jordan, can you leave that 1-minute sign? You will see that 1-minute sign, and then after 10 minutes, you will have to stop the presentation. You cannot continue. The judges will have 10 minutes per Q&A session. Only judges can ask questions. The winners will be decided by combination of written score and tonight's presentation. So tonight's presentation accounts for 50% of overall grade. 50% has already been determined by your written results. There are no cell phone allowed at the university club. That's the club policy. So anywhere inside the building, you are not supposed to use cell phones. If you need to make a phone call, you can step outside. Also, if the teams have extra time, since you don't know in which order you will be presented, you are free to use a coffee store close by or go outside and come back. Just make sure you're back when your time is to present. Audience members should remain silent. Please refrain from leaving while the presentations are going on. And then once the team are rotating, you can step outside for a drink or restroom breaks. Academic advisors and industry mentors can decide to watch presentations or stay with the team. So if you are a volunteer with the team and your team hasn't presented yet, you have to choose whether to stay here or stay outside, but you cannot go back and advise the team before they present. And then once your team is done presenting, then the entire team can come back and watch other teams present, and the advisor is also, it can freely move from inside to outside. And here are all the teams presenting tonight, and we also posted resumes of all the students that submitted them on the CFA Colorado website. And we might have HR or people that are looking for interns or entry-level positions. They're welcome to access the resumes or contact the society if you would like us to email you the student resumes. And on this note, we would like to determine the order in which teams will present. Right now you will see just a list of teams, and I'll click F9, it will randomly generate the numbers. So right now, don't pay attention on the numbers. And then, so in the new order of presentations is, so this is the order in which teams will present. So right now, the CU Denver will be presenting first, followed by School of Mines, and then that's the remaining order. Just make a note in which order you will be presenting, and all the teams except CU Denver have to rotate outside and wait in the waiting area, or you're free to go outside the U Club. And if you have any questions, just raise your hand. Right, I would like to please welcome Team CU Denver.
Thank you. Welcome, judges, members of the CFA Institute, and esteemed guests. My name is Brody Norcott, and standing beside me is the team representing the University of Colorado, Denver. Sell. We recommend a sell for Charles Schwab Corporation. Our tagline for today is good company, high price. We will discuss the good company behind Charles Schwab in the beginning and then transition towards the middle and the end and discuss a little bit more about our high price. So here's Kevin, and he will discuss a little bit more about the business overview.
Thank you, Brody. There are three main reasons we believe Charles Schwab is a very strong company. First, they have incredible brand recognition. Second, they have investments in place for future potential growth. And third, they have an enormous amount of money in assets under management in excess of $2 trillion. The two reasons we believe Schwab to have strong branding is that they're a very well-established company with nearly about 40 years since incorporation. Also, they offer a very diverse array of products to their advisor and investor clientele, which reduces the risk of losing their customers to competitors in the industry. Those are the two main reasons we believe Schwab has a good brand. And my friend Wyatt here will go further into their future growth prospects.
Awesome. Thank you, Kevin. So we see two major opportunities in the near future for Schwab. The first is international expansion. Markets such as China are seeing record-breaking financial growth, and Schwab has yet to indicate that they're intending on really capitalizing on that market. The second opportunity that we see for Schwab is their upcoming intelligent portfolio manager, the industry being robo-advisor. This system is an algorithmic portfolio management system that will automatically try to maximize your portfolio growth. We do believe it's going to reach a larger demographic with its more account types such as IRAs, 401ks, traditional accounts, as well as it has the added benefit of tax loss harvesting. We are foreseeing, and we did calculate for a number of detrimental factors to this, which are, we do believe internal competition is going to exist, as this is going to be offered alongside its more traditional advising services. Also, external competition is growing with services such as those algorithms provided by Betterment and Wealthfront. In addition, bias towards Schwab ETFs is currently unclear. We're not sure what the mix of this system is going to be. So to talk about competitive advantage, I'm going to turn it over to Brody.
Thank you, Wyatt. So judges, what you see here before you is a basic Porter's five forces analysis, which rates the overall competition within an industry, specifically the asset management industry that Charles Schwab operates within. As you can see, we've got the five basic threats of competition. We've got threats of new entrants, bargaining power for suppliers, competitive rivalry, bargaining power for customers, and threat of substitute services. As you can see here, competitive rivalry we rated extremely high because of all of the different competition within all the different firms that are part of the industry. Bargaining power for both suppliers and customers was fairly low, as well as the threat for substitute services. As you can see, threat of new entrants was also very low, and we saw that because of the introduction of new regulation, which we will discuss a little bit later on towards the end of our presentation here. Now, Schwab offers 16 unique actively managed funds. We decided as a group to pick 5 of those and look at them from the perspective of an investor, as if we were looking to place our own assets in some place. What we did was average those 1-year, 5-year, and 10-year returns. And what we found was something very interesting. Charles Schwab funds, on average, returned less compared to their competitors, Vanguard, Oppenheimer, and Fidelity. Another key point is their average expense ratio was higher than their competitors, meaning investors were paying more to return less. Now let me turn it over to Brad, who will get into the real important part, the financials and valuation.
Thank you, Brody. So now that you've heard about why the company Charles Schwab is good, I'm going to tell you why you should sell the stock if you own it. So 3 main things that you should take away if you don't listen to anything else I say. First off, we did many different valuation measures. We tried DCF, CAPM, dividend discount model. Basically, the reason we did all that is we wanted to make sure that there was, cohesiveness in every single model we did, which would end up at a sell, which it did, and I'll go into that. And then also their declining new asset growth rate. Obviously, in an industry that's measured in assets under management, you want to see the new asset growth rate climbing as opposed to a negative number. And then also relative valuation measures. Schwab is relatively overvalued compared to its industry, its peers, and then the S&P. So looking at revenue, obviously it's a positive trend. One thing to note about the revenue growth is it's not as consistent as far as the actual overall, net revenue numbers. Obviously, you want to see a good, strong, consistent revenue growth rate. And then one thing I want to point out here is total expenses as a percentage of revenue. Schwab is great at cutting costs. The downside with this is currently they are pretty lean. Obviously, they're almost as lean as they've ever been. The only negative with that is obviously, there's obviously going to be a floor for how lean they can run. Where that is, we don't know, but we kind of see that as a negative. And then finally, for the financial ratios, I want you to pay attention to here Schwab, return on assets, return on equity. Obviously, these are things that you use to value, their uses of capital and equity. Right here, Schwab is in the middle, 11.66 for return on equity, 0.79 for return on assets. In the middle, meaning between E-Trade and TD Ameritrade. And I'll come back to why that's important, but for the future, you should think, okay, this should trade in the middle as far as a multiple of both of these companies. And then here's that new client asset growth rate, a negative compound annual growth rate of 47%. And this is from 2011 to 2013. Obviously, 14 numbers were not in here. We had to turn this in on the 5th of January. And then going on to the sensitivity analysis. Obviously, I mentioned we did many different models. We want to have a robust portfolio of models. Best case scenario that we calculated $27.59 per share. Worst case, $24.94 per share. And then our recommendation, our target price, $26.21 per share. Obviously, the thing to note here is the best case isn't really much of a good case compared to where they're currently trading. And then relative valuation measures currently, and this is in December, 32 times earnings is what Schwab is trading at. TD Ameritrade, 25 times earnings, E-Trade, 22 times earnings. So if you go back to that ROE and ROA, they were in the middle, but you're paying more for Schwab's earnings than you are for E-Trade and TD Ameritrade. And then they're obviously higher than the S&P at 16 and the investment brokerage subsector, and also higher than their average over the past 10 years. And finally, I want to leave you with some correlations. So everybody tonight is probably all going to be talking about the federal funds rate. When's that going to rise? Is it not going to rise? The thing here, you're probably not going to see the colors, but this is the federal funds rate quarter over quarter change, GDP quarter over quarter change, Schwab's stock price, and the S&P. The thing to note is there's no inherent correlation between the stock price of Schwab and any changes in the federal funds rate and GDP. And with that, I will leave it with Zach to go over the risk analysis portion.
Thank you, Brad. So now that we've talked a little bit why we think Charles Schwab is a good company but has a high price, I'd now like to talk about some of the investment risks to consider. The first section I'd like to consider is the operational risk. Charles Schwab has a very high exposure to regulations. One example would be the Dodd-Frank Act, all about liquidity and oversight costs. Next, they also are subject to technological risks, which include security breaches or system failures. The next section I would like to talk about are market risks. One example would be credit exposure, such as clients trading on margin. They also have a risk to changes in interest rates. As Brad just mentioned, he just talked about how there's not much of a correlation in our findings between the stock price and the change of interest rates. However, it is still a risk to consider when you consider the effects to net income. And finally, I would like to talk about external competition. Competitors are often merging in the financial industry so that they can compete with financial companies like Charles Schwab. They always are growing their client assets base. They're also trying to offer new services. And last but not least, I'd like to talk about the extraordinary human capital. Tons of competition in the financial industry. It's something to consider for a risk for Charles Schwab.
So in conclusion, Charles Schwab is a good company, but is currently trading at a high price. So we are issuing a sell recommendation for Charles Schwab. It has a good company, good, strong brand recognition, as well as doing well by investing in the future through intelligent portfolios. But based on the many different models that we ran, as well as a few of the relative key ratios that we went over, we are issuing a sell recommendation because it is overvalued. Thank you. We would now like to open it up for questions.
You talked about some of the expansion, the potential for expansion in international markets, China in particular. That's concerning to me because of what's going on in China. Can you talk more about what is management at Schwab doing in order to penetrate that market effectively?
Thank you. That's a great question. And Wyatt has a great answer for that. I'd like to allow him to answer that.
So we found that a little concerning too. Many international markets are, they're, for lack of a better word, booming, and we would like to see Schwab take advantage of some of that. But I do think they are playing, well, we think they are playing it a little safe, kind of waiting for some more revenue generation to where it's a little safer to expand into those markets. That's the sense that we got when we.
And we did include that as a weakness in our report when we did a SWOT analysis. We do believe that there is opportunity internationally, but it's also a weakness that we believe that they should actually expand on that.
When you looked at the actively managed funds, did you look at what percent those funds are versus passively managed funds and what expenses passively managed funds compared to competition?
Not quite sure I understand that question. Do you mind?
I can actually answer that for you. So yeah, the reason, I mean, we obviously only picked 5, and the reason we did that is because, you know, if you go back to that slide, we wanted to make sure that they were, you know, as close to each other as possible as far as like small cap stocks. Like if you look, you know, mid cap, you know, as far as what they were investing in, the you know, their investing philosophy, we wanted to be closely matched. So we picked 5. The reason we didn't do passive is because, you know, we kind of wanted to make it from a customer perspective as far as if I had $1 million to invest with a company in an ETF, you know, and it was going to be an actively managed fund. Would I want to go with Schwab? Would I want to go with you know, Vanguard, Oppenheimer? Basically the same analysis a customer or potential customer might do. And obviously that directly translates to assets under management.
Similarly on the profitability, where do you see the profitability in the investor services versus the advisory services? And what do you see expanding or contracting those margins going forward?
Touch on that. So, Schwab's main source of revenue growth from our presentation that they're expecting is growing assets under management, and in turn, hopefully, the Fed's fund rate rising. And they're currently waiving $800 million in fees a year for money market funds, and they need the rates to rise to 75 basis points to completely eliminate those fee waivers. And the main sources of revenues we're expecting, and it's not in the next year because we don't think rates are going to rise in the next year, is from growing assets management and the rise in the Fed funds rate.
And a little bit to go off of that as well, DARTs, which is the term daily average revenue trades, as an actively discussed through brokerage firms. That's another way that Schwab can definitely look through growing some more revenue. The only issue with that is, especially when we're seeing some of the tumultuous times in the market recently, revenue volume for revenue or for trades tends to decrease. So that is a bit of an issue in terms of revenue from the trading aspect of the investor services.
And going off the interest rates real quick, we believe that even if rates do increase this year, they're not going to increase enough where they can start waiving, or they'll have to continue waiving those money market fees.
Could you expand on the valuation methods, how you weighted each of them to come to your conclusion, and what you learned about financial companies and which methods are most conducive to value?
Well, I would say the dividend discount model is definitely not the model that we used. That returned very low value. As far as the different models, if you look online at different sources, Bloomberg, Capital IQ, and FactSet, there's a range of betas. So the biggest thing that we did obviously a dividend discounted cash flow model, projected out financials, and then we basically obviously did capital asset pricing out, and we looked at different betas. That was the biggest thing we did because there was a range from about 1.25 to 1.5. So we looked at different betas and then ran regressions looking for the highest predictability. I believe the actual time frame that we used was monthly, comparing monthly returns of that Schwab to the S&P over 5 years. I believe we treated the highest predictability, and that's ultimately where we returned our discount cash flow model. And then also, if you look at the PE ratio, you can see it's further back. You can see, so with our projections, revenue projections for 2015 and our valuation, it does bring it back down to 26 times earnings, which is slightly below their average PE ratio, but our valuation was kind of justified in that sense because it brings it down to closer to our average PE than what they're currently trading.
The dividend discount model, from what I saw from your report, you got $4.
Yeah, and the finance, yes.
Yeah. Do you think that there's a reason that that model is not applicable to this company?
Everything I researched was basically before I even did the dividend discount model, kind of predicted that would be the case. The thing with Schwab is they have issued 99 consecutive quarters of dividends, and they have raised it 19 times, which equates to roughly every 5 quarters. But they haven't raised it, and I believe it's 3 or 4 years. So coming up with an actual growth rate, there's not much of a number that you can really go off of because yes, they've raised it 19 times and it's consecutive, but it's, they haven't raised it in 10 to 15 quarters. So it's kind of hard to predict, and therefore we kind of didn't see that as a good model to use.
I could add to that, and also many of the financial stocks that we looked at for comparison, you could clearly see that they were hybrid models, and the dividend discount model wouldn't be applicable to them. So there would be a tasty dividend, but as well as they were attempting to provide growth as well to the investor, and that was a pretty common theme that we saw throughout this entire industry.
In looking at the price to earnings ratio comparisons, talk a little bit about Schwab, so the interest rates, some other ones. Trying to dissect what Schwab's related to that.
That's definitely a very good question. And unfortunately, we didn't look at the overall effect, and the reason we really didn't is because looking at that correlation, we didn't feel like there was a strong enough correlation to make any assumptions based on the actual stock price. Obviously, it's going to translate into their bottom line and top line, but as far as the actual stock price, there wasn't a high enough correlation for us to use that in our considerations.
Interesting analysis. What would you guys say, any of you, is either the most exciting or challenging thing in front of the company that you discovered through your analysis of it?
Yeah, I'll take that. Thank you for the question. We found a little bit difficulty when we were going through the balance sheets and the income statements and trying to project them. There was a lot of the financial services balance sheets tend to be very difficult to understand because there's so many different sources of revenue to draw from. And what we also found, and Brad can attest to this a little bit as well, there was a little bit of difficulty in terms of some of the projects that were on the balance sheet that were ending, and we weren't quite sure when they were going to end and when the terminal cash flows were going to be for that. So it was difficult to predict those into possible future revenues.
The other thing I would definitely like to add to that, I'd say the hardest thing for me was, obviously we went through the models and you'd come up with a target price, but I'd say, listening to you go at the campus, pretty convincing as far as it was a good company. So I think it's definitely hard to come up here and say, well, this is a really good company, but we think you should sell. It's kind of contradictory, but I'd say that was the most interesting thing from my perspective.
Adding on that, the financial industry, it's a much different kind of industry than doing a company like Molson Coors.
1 minute of questions for me.
It's all service orientated. It's all money. So it was a different kind of feel than that we've noticed other groups in the past had done. And we were ready to accept that challenge, I think, and we learned a lot. And I think we have a good, I know we have a good recommendation.
So what do you think the market is seeing, giving it a higher PE than its peers?
Well, if you're keeping up to date with the market right now, our target, the current price is only 60 cents away from our target price. And I think the market agrees with us. After the fourth quarter earnings, Charles Schwab stock kind of went down closer to our target than it was when we submitted our report at
But the PE is still higher.
I'm sorry?
I could probably answer this. I think, E-Trade, if you look at it, half those years it's had negative earnings per share. So, it's not as, obviously this is a strong brand, this is a strong.
Thank you. That's good.
All right.
Thanks.
and the net interest rate. Trading revenue is driven by the client's trading activity. Compensation and benefits account for more than 50% of Charles Schwab's expenses. This is primarily due to a new incentive compensation schedule rolled out in 2012 to recruit and retain RIAs. The investment banking and brokerage industry is currently in the mature phase of the industry lifecycle and is highly regulated. Firms in this industry are constantly striving to lower costs and remain competitive. Lower costs are achieved through technological advancements such as improved trading platform and robo-advising. The attraction of high net worth clients is also a high priority, and this is done through the improved advisor services. The improvement in advisor services has in turn increased competition to recruit and retain RIAs. The companies in this industry are also experiencing negative effects due to the low interest rate environment. My teammate David will now continue with this discussion.
Thanks, Kara. So as we know, interest rates since 2008 have been near zero, okay, but this situation is expected to improve in 2015, however, as the Federal Reserve Board recently announced an increase to their target federal funds rate. Moving on to our U.S. GDP, by the third quarter of 2014, U.S. GDP experienced an average annual growth of 3.5%. This situation is expected to improve in 2015, and GDP is expected to grow at a rate between 2.6 and 3%. Moving on, additionally, the index for real personal consumption expenditures for financial services and insurance has grown by 8.5 points since 2012. Combined, all of these conditions create favorable conditions for firms such as Schwab. Moving on in our industry overview, here is our Porter's five-force analysis. Firms in this industry face medium capital requirements as well as high revenue volatility. Technology change in this industry is low since there haven't been many technological breakthroughs. Here we have the net margin of Schwab and its peer group, which includes TD Ameritrade, E-Trade, Raymond James, Ameriprise, and LPL Financial. Firms in this peer group were selected based on having similar major lines of business as Charles Schwab. Okay, I'm going to move on. And I'll pass it on to Yue with our investment recommendations.
Thank you, David. Based on our analysis, although there are several positive indicators for Schwab's performance, the total return on Schwab is still in line with the returns on S&P 500. Thus, we issue a whole recommendation with a one-year target price of $30.23. We are expecting a positive interest rate environment. Considering the expected increase in the 10-year Treasury rate and also the target federal fund rates, we are confident that fee waivers will go down and drives up Schwab's revenue. Other than the external factors, Schwab's planned asset base has increased by a compounded annual growth rate of above 10% for the past 3 years. Particularly, assets under advisory solutions has increased by a CAGR of 17% for the past 3 years. This strong growth in assets under advisory will help Schwab grow their revenue. Based on this, we have forecasted a steady revenue growth for the next 5 years. In terms of capital structure, Schwab's current leverage ratio, 15.4%, is well under its stated cap of 30%, which enables it to raise capital and expand in the future. Moving on to the dividend. Schwab has a steady dividend paid out from 2009 to 2013. However, we are expecting Schwab to increase the dividend from 2015 in line with the stated paid out ratio of 20% to 30%. Now I'll pass it to my teammate Dylan to further discuss.
Thanks, Yue. The corporate governance is structured with an overall alignment between management and shareholder interests. There are separate roles for chairman and CEO, which increases managerial accountability and reduces potential abuse of power. Additionally, the committees are structured so that board members, there's required to be a majority of independent board members who are not allowed to sit in on the board of more than 2 other publicly traded companies, which reduces potential conflict of interest. Over the past 3 years, the percentage of long-term incentives in the executive compensation package has been increasing. This provides additional assurance that the interests of management are aligned with the shareholders. Schwab Bank is subject to the final capital regulatory rules. Currently, the bank is positioned with ratios that consider the bank to be well capitalized. Additionally, however, reaching compliance with the modified liquidity coverage ratio will have a slight negative impact on Schwab's earnings per share by about 0.5 penny per year. Our analysis consists of 2 absolute and 2 relative valuation models, which have forecasted a 1-year target price of $30.23. Raj will now expand on our valuation methodology.
Thanks, Joel. As mentioned earlier, we have been forecasting increases in the dividends over the next few years. So a dividend discount model has been used with a 7.75% terminal growth rate and a 25% payout ratio. Also, given the inherent difficulty in defining the debt of financial services firms, we have used an excess return model with a 9.52% long-term cost of equity and 10.35% steady-state ROE. Also, we have observed a significant volatility in the Schwab's price-to-earnings ratio. So a 10-year historic P/E has been considered as the 1-year forward estimate. Similarly, to account for the volatility in the price-to-book value ratio, we have used the 10-year estimate as the 1-year P/E. Further, to determine the predictive power of the valuation models, we have run a regression analysis between the model indicated prices and the actual prices over the past 20 years. The resulting correlations from this analysis are used to assign weights to each of these models, resulting in a target price of $30.23. Further, to assess the sensitivity of the inputs we have used in our analysis, a far number of scenarios have been considered. In this thing, if you could look at the most pessimistic scenario of 1 percentage point increase in the cost of equity and is 1 percentage point decrease in the revenue growth, we could see a 12% reduction in the target price from your base scenario. However, in the most optimistic scenario, we could see a 42% escalation from our base case scenario. Moving on to risks, these are the major risks Schwab is exposed to. However, we particularly feel interest rate risk and the regulatory risk are the major risks for Schwab. Now, Kira will conclude our team's analysis.
Thank you, Raj. Considering the positive U.S. economic outlook, Charles Schwab's strong revenue drivers, and increasing client base, our team projects a 7.26% total return, which is in line with the expected S&P 500 returns. Therefore, our team issues a hold recommendation. Thank you. Are there any questions?
In your valuations, you used 2 cases in 10-year historic. What's the basis?
We have been observing that Schwab's P/E is trading at a premium consistently compared to its peers. We have observed the Schwab's peers median P/E over the past 10 years, but it has been almost all the years it has been trading at a premium. So a measure which is more relevant to Schwab itself, like its more historic P/E, is considered to be more relevant or the reliable indicator to determine the P/E. So as we have said, to assess given the volatility in the P/E, we have used the 10-year average.
The dividend discount, you placed a lot of weight on that, and you're forecasting quite an increase, dramatic increase. Their payout ratio has varied quite a bit year to year. How is it that you're comfortable forecasting that much growth in dividends?
So one reason we did that was because with the forecasted improved economic situation, we do project the dividends to increase and thus become a more significant factor in the model. And I think that's part of the reason why we did weight it as we did.
Further to add on, the payout ratio has been volatile. For the past 3 years, it has been reducing from 35% to currently it is 30% as the payout ratio. However, given we are forecasting increasing EPS, so we could see the payout ratio actually going down if the current 24 cents move forward. So, but like Schwab has already stated, its dividends will be in the range of 20 to 30%. So we are expecting the Schwabs will be increasing dividends in the coming years. So a dividend discount model has been hence used.
I see that your weighting is higher for price to book value. Could you discuss the advantages and disadvantages of overweighting price to book value compared to PE for a financial company specifically?
Yeah, true. But coming to Yeah. Although we got like our regression analysis given as like 83%, like 80.83 to correlation. Yeah, for the financial services firm, we generally think of they have more tradable investments or the assets and liabilities which can be determined on a fair value basis. However, if we could see like for the manufacturing companies, there is more like a goodwill associated to it, like which premium can be associated. For the financial firms, we can definitely assign a fair value. So a book value actually gives us a more decent indicator than the EPS. So that's the reason.
Yeah, also to expand on that, we did use historical data and utilize this model to see how it would forecast our result using the historical period, and we assigned a weight in accordance with that accuracy.
In a competitive environment like the brokerage industry kind of thing, what is Schwab doing to sustain itself?
Actually, firms in this
No, you're good.
firms in this industry are firms like Schwab. Firms in this industry are competing by trying to attract more high net worth clients. In particular, the way Schwab is competing is by decreasing its expenses. It's very good in controlling its expenses through cost-cutting measures such as robo-advising and Schwab portfolios. That's what they're doing, cutting costs and while attracting high net worth clients.
It seems like that would be in conflict a little bit with their RIA platform. Thinking about how they marry those two, how you say the client is specific on the Schwab platform and then still supporting the RIA.
Right, I definitely understand that. That we do see, and Schwab, when we spoke to them, they mentioned to us that there may be some cannibalization taking place as far as their other lines of business. However, our recommendation or valuation was based on modest switches or not too much business going over to the other
branches
as well. Yes, that's another advantage that Schwab has, is that they have so many branches within the rest of the firms in the peer group.
Also, to add to David's answer, it's like currently the investors are more looking towards the registered investment advisors. So Schwab is in a current position to tap that potential, like providing services to that RIAs, and then in turn like trying their clients. So we see that as a positive feature for Schwab.
You talk about cannibalization and expansion of branch network. That seems to be some pressure on margins on both counts. You've got margins going from the mid-30s to 57% in 2019 or however far you carry it. How does that work? What drives that such a dramatic increase?
Basically, currently coming on to the operating margins which we are discussing, even the Schwab is already planning to increase the branches. We currently see that the interest rate environment, which will be positive in the future, will be actually driving the operating margins. Because Schwab is experiencing a very good expense control in other areas, they will be able to offset these increasing costs in terms of branches with others. Like currently, we could see Schwab is like moving some of the operations to Colorado, so that will be decreasing the real estate expenses and further like various expenses to some extent. So we pretty much think of it will be offsetting and it will be good in terms.
In your outlook, increase in short-term rates. How does your recommendation change?
So when there is an increase in the short-term rate, if there is a very sudden and abrupt increase, we'll recommend it to buy instead of hold.
To add on to that, like if the current interest rate environment actually continues into the future, like the low interest rate environment, we would then like probably like moving our recommendation from hold to sell, because Schwab's is significantly dependent upon the short-term interest rates.
The relative PE for Schwab versus its competitors, what drives such a fairly dramatic difference?
It's more based upon the, like as we have mentioned before, like it has been continuously trading at a premium P/E to its peers. Primarily, we could think of the reasons because Schwab is in a very good position because of its innovative practices. Like it has been introducing some of the other innovative stuff like the robo-advising. So people are like, all the factors, in fact, the growth factors which you have mentioned before, already accounted into the Schwab's market price. So that's the reason why, particularly, we feel E by E is at a premium.
You talk about the electronic or the robo-advising. What is it about the demographic that makes sense? I can't see myself doing that. I'm going to talk to a person. Robo, that's a terrible name.
The robo-advising is, from kind of what we looked into, it's a way to target younger investors. The younger generation has grown up with technology and are used to having technology at their fingertips. So the robo-advising offers a investing solution to that generation. And as the demographics change in the investing industry, that is a really big market to tap into. So that's kind of like the purpose. From what we kind of understood, that was the purpose of the robo-advising, is to attract a new demographic of users to the investment.
So it's lower minimum, it's got a low minimum, and it's kind of demographic for people that don't have $7 million plus to invest.
Right.
Yeah,
So
yeah.
it's generally lower income, and obviously there's going to be the lower fee involved, which will attract a different demographic. And really, the main benefit here is there's these startups like Wealthfront out there that could potentially neutralize some of Schwab's clientele if Schwab does not position itself in a way to maintain that current market share or expand on additional clients who may be more geared towards this type of technology.
We have time for one more question.
Thank you.
Thank you very much.
So please welcome the University of Denver.
Hi everyone, we're a team from University of Denver. I'm Venus. This is Sam, Natalie, Jonathan, and Jasmine. We are here to present our investment recommendation for Schwab. According to our valuation, we initiate a hold recommendation for Schwab. Our 12-month target price is 29.31, and according to the chart, you can see the Schwab performance last year is matched the benchmark performance. So we strongly believe Schwab is fairly valued right now. So I will speak a little bit about financial service industry. Since the 2008 during recession, the government took a lot of measures to regulate and enhance the transparency of the industry. And the Fed in QE3 last year, which means the economic outlook is pretty good right now. Combined with the high GDP growth, low unemployment rate. So more and more investors within the face of the financial service industry. So we strongly believe there are plenty of the opportunities for investors to invest this sector. So even though we give Schwab a hold recommendation, we strongly believe Schwab is a long-term investment based on 4 reasons. The first one is Schwab has competitive advantage, which means Schwab has constant innovations, customized products, and Schwab is market leader, and Schwab also has a really great growth. The final thing is Schwab can benefit by the future interest rate. If the interest rate going up, Schwab will make lots of money. So it means Schwab can benefit the interest rate in the future. So next, Sam will speak a little bit about business description of Schwab.
Yeah, just a little background info. Schwab was founded in 1972 as a brokerage firm and has kind of been known throughout the years as a discount broker offering lower commissions and fees than their competition, and more recently focused a lot on the asset management, wealth management side. Schwab operates in two major segments: the investor services and advisor services. Investor services being the retail brokerage, and advisor services creating an advisor services for independent advisors to hold their assets with Schwab. And just a couple products and services offered by Schwab. And here, according to this one study by PricewaterhouseCoopers, you can see global assets under management managed by asset management firms. It's consistently growing and projected to keep that consistent growth, with Schwab having 43% of their revenue coming from fees from their asset management. This is very good for Schwab. Some of the growth factors for this growth in asset management, you can see high net worth individuals and mass affluent are two of the biggest factors growing there going forward, which is great. This high net worth individuals is a big target of Wells Fargo for their wealth management wing. And some of the biggest industry trends that we noticed being the end of QE3 and pending rising interest rates bodes well for Schwab, seeing that 38% of their revenue does come from interest revenue from holding funds. There's a big focus on capital preservation and transparency with baby boomers reaching retirement, as well as lower investor confidence after the global financial crisis, showing a need for corporate governance and risk management over capturing alpha. Customization of products over this past product push approach to kind of generate more AUM. Investors are shifting more towards, they're realizing some of these products are just expensive beta generators and they want more customized, tailored solutions. And with the impending regulation coming down the line from the Department of Labor, which could potentially make broker-dealers as accountable as RIAs, Schwab has starting to deal with that by moving some of their broker-dealer business to RIAs. I'm going to hand it off to John for financial analysis.
Okay, so I will discuss the financial analysis part for Schwab. As Schwab is a wealth management company, we can analyze Schwab on two sides. The first side is the brokerage side. The second side is the asset management side. So on the first side, the brokerage side, we use the net new client assets. This is an indicator to show the brokerage size company's performance. And we use E-Trade and the TD Ameritrade as the comparable companies for Schwab. As the first chart on the right side shows, that the by adding back the 2010 and the 2013 mutual fund cleaning service outflows, Schwab will have a stable growth in the net new client assets, which is this red line here. On the other hand, Schwab also has a good average revenue per trade, as this red line here on the second chart. For the second side of Schwab, we analyze is the asset management side. On this side, we use the asset under management indicator to show how good the Schwab has performance. As the chart shows that the red line in the middle is Schwab, and it has steady growth during the past 5 years in the asset under management. And by the way, there is a small mistake here for Janus in 2011. There is a missing zero here, so this point should be somewhere near here. And for the asset management side, there is another indicator, which is the institutional asset under management percentage. This percentage is really important for the asset management companies. For this indicator, Schwab has a percentage of about 40%. For the profitability, Schwab also has outstanding profitability, which has a return on equity in the past 5 years about 12%. And the financial statement structure is also looks in line with other competitor companies like E-Trade and Janus. So I will pass it to Natalie for the.
In order to perform valuations, we estimated expected earnings and revenue growth for the next 5 years. being earnings 15% and revenue 10% for the next 5 years. We realized that earnings grow faster than revenue, which is based on improving profit margin of the company that contributes to EPS that's growing faster than sales. Also, the estimates are in line with Capital IQ consensus and with historical growth of the company. The required rate of return that we used was 10.15%, and it was based on the 3 methods that we used, Gordon growth model. And for that, we assumed that dividends are going to grow at the constant rate of 24 cents a year. For the CAPM, we used risk-free of 2.16% and risk premium of 5.21%, which is based on the research done by Demotaran, who's an NYU economics professor, and this rate is appropriate for financial services companies. About valuations, our target price is $29.31. We estimated it by averaging 4 methods: free cash flow to equity, residual income, price to earnings, and price to book value. And according to our valuations and research, Schwab is fairly priced as of right now.
Okay, in the perspective of an investor, you really care about the profit, but you also need to consider about the risk. This slide lists all the risks Charles Schwab need to consider about that. And the most important risks are the interest risk and the political and operational risk. For the interest rate risk, although Federal Reserve predicts that the interest rate will drop, but in the future, will be up. But in the future, we can see that because Europe and Japan, U.S. interest rate will still going down. That will hurt the Schwab, because Schwab got revenue 38% of the whole net interest revenue. As a low interest rate, they will hurt lots of revenue from their side. For the political risk and operational risk, because lots of the financial service and banking face the issues regarding with the information security issues. So Schwab, as a leader, this company also facing some service attack and some technology issues as well. So finally, I want to point out the market volatility, because right now the oil price is dropped hugely, and the historical data indicates that as a dramatic drop in the oil price, the actual market will also perform badly. So Schwab needs to really consider about some market factors.
Thank you.
Okay.
That is some pretty dramatic margin growth that you're forecasting. Can you be specific about what drives that? And do you see higher in investor services or advisory services?
In my opinion, the growth, since investor services they take much more percentage from revenue from investor services, but our point of view is that advisory services is the one where we see the growth potential. We can see the decrease in some of the cost expenses, and I think that's what driving the company and being the leader in the market and kind of middle market size companies.
In some of your growth factors within financial metrics, focusing on global assets management. Schwab is a U.S.-based company that focuses mostly on U.S. customers. Does that change the kind of market models?
Yeah, Schwab is shifting from the traditional brokerage firm to the asset under management, and we've watched the business model for Schwab, and we found that the most revenue source is from their asset under management part.
Yes, especially Schwab have other branches in other countries, not only in the U.S. But we know the 80% of the asset under management is based on the U.S. market. But the chart we provided is just to give the audience the overview how the asset under management is growing. It shows the U.S. market. It grows really fast.
And Schwab increased a lot of customer base on the part of the asset under management. That's also the drivers for the growth.
The institutional ownership looks like over the past year or so. Is there any trend in that relative to stock ownership from the mutual funds and outside of leisure players?
Could you repeat your question again?
The question specifically is, does a big mutual fund company that might hold financial companies like Fidelity have a big position in Schwab? And have they increased it or decreased it, or maybe related is the inside stock ownership? That could be an indicator of what other people think of stock. I'm not sure.
Yeah,
Okay.
not sure.
Okay.
Yeah, we just only sure Schwab's use a lot of other companies, the mutual funds or ETF.
What is Schwab doing to distinguish itself from the marketplace among the competition?
One thing they've done is move some of their broker-dealer business to these, like the network of independent IRAs. There wasn't, really any manager's comments on that, but you would assume it's because of this impending regulation coming down from the Department of Labor as broker-dealers become more accountable and have to disclose more to clients. Maybe they'll want to move towards RAs as they see things they've been doing in the past.
The other thing I would say is the innovation, even coming up with the intellectual portfolios. That's something that definitely distinguished Charles Schwab from similar or even competitors. And the other thing is probably customer service. That's something that Schwab is famous of. And that's something that's different because people are attracted to companies that provide that kind of one-to-one service where you can actually ask questions and get familiar with the accounts or just get an advice simply. And that's different about Schwab.
Yeah,
And that also helps them, they're poised to take advantage of shifting trends as far as lower investor confidence. They're not okay with these black box investment models. They want to know what they're doing with their money, higher client education, higher client engagement, that kind of thing, things that Schwab's good at.
especially Schwab ranked as #1 of market share of the asset under management, which is 1.08 trillion. So we believe Schwab is a market leader within the brokerage service industry.
Yeah, and compared to other competitors, they just cut their expense, so they have more resource of money to have some expansion plans in the future years.
Yeah, but we do believe those competitive advantage is stock price will reflect those advantage in the future, not within a year.
One of the larger factors in your valuation model is assets under management. Were you able to isolate the effects of market growth on those assets versus acquiring assets from competitors and getting market share?
We did not isolate that. We kind of took everything as a one. We thought it was more appropriate, but it's just, I guess, personal view on valuations.
In the financial analysis section, you approve valuations. You've got the slide trade and above that it's something like net new assets and reduced
Yeah. Yeah, so if we go back to so this one, the red line here is the Schwab's net new client assets divided by the total client assets. Because we want to compare it with other two companies, which is E-Trade and the GP Trade. Because the asset size is different, so we use this ratio here to compare these three companies. And we want to discuss why these 2 points is low. So as we read all the changes and all the details, we find that these 2 points are related to the mutual fund cash outflows for the cleaning service, and which is the huge amount, which if we add back that two amount in 2010, 2013, this 2 point will go back like this place here, and that means Schwab will have a steady growth in the net new client assets line here, as we shown on this picture.
Did you look at the figure as of 9/30/14?
I think.
No, that was 2013 that we looked at.
I'm just wondering if you are aware of any other trends that.
Well, we are aware that Schwab is increasing their client base, and that's constantly growing, as we read in the new report. But on this particular slide, we just look at 2013. We just wanted to distinguish the company and look at the competitors, how it did during that time.
Do you sense for what is happening with management, given the fact that Chuck Schwab, the founder, I think at one time he gave up ownership of the company and came back into it? Do you get a sense for the state independent company or merge or something like that?
I mean, since Schwab is a leader in the market, I can't see any other company acquiring Schwab right now, but I could see Schwab acquiring a smaller company, maybe some company that's like E-Trade dealing only and mainly with kind of internet and online version of the portfolios. But Schwab is really strong, and I feel like if they have excess of cash, they can definitely go for a smaller company just to capture more market share and maybe kind of switch. I know Schwab is in the mid-market, but maybe they could a little bit grow by acquiring different companies that were they maybe not as experts as other companies are.
Maybe they want to go abroad to acquire, other companies in like Asia Pacific, like Hong Kong area. They want to develop their business outside of the U.S. They may acquire other brokerage service companies.
Are they using their cash? Are they buying back shares? What do they do with that property they just put up in Colorado? Do they pay for that or do they
They pay for
that big campus that in Lone Tree?
Oh, you mean the new building?
I think they pay for that because I heard my real estate professors, and he told me that no rent, maybe pay, but I'm not pretty sure. We can go back to
I think they're mainly using cash for investment, so like investment in new buildings, investment in this intellectual portfolio, just kind of capturing new growth market and going in different direction, not only staying with their kind of regular business model.
We have time for one more question. Is
there some action that they could take, management could take, that could cause you to get enthusiastic enough about this company to put a buy rating on it?
Personally, more of an effort shifting things towards RIAs, away from the broker-dealer business. Their broker-dealer business is somewhat eroding, seeing price competition from E-Trade, Scottrade, these kind of things on commissions, and that combined with potential new revenue that could just cause a compliance headache and also change the regular way the broker-dealer do business. Really show that they're really changing with the times, innovating moving forward rather than trying to keep on pushing what they're doing despite of
Actually, we didn't initiate a buy, not only because we didn't see the increasing stock price within a year, especially Schwab in the financial service industry is not really a small cap financial service firm. It's like a little bit big market cap. So we strongly believe those kind of firms within the financial service industry, they are still recovering. So we don't think it's a business about the company can do anything about the entire market. We just think right now the investors are not really bullish for the financial service firms, which has a big market cap. Especially you can see the Goldman Sachs, Bank of America, their performance within a half year, they're not really good. A lot of investors don't want to invest in it. So, but they still generate really great earnings. So I don't think it's about the company itself. It's about how investors believe the market.
I agree.
I'm Marshall Egg, and I'm a senior studying finance and economics.
My name is Everett Randall. I am a sophomore studying finance at the University of Colorado.
My name is John Maslin. I'm a junior doing finance.
We're the University of Colorado Boulder, and today we are going to present a buy recommendation for Charles Schwab. On the screen is a quick highlight of the company. Charles Schwab was incorporated in 1986 in San Francisco, California. The business is broken down into three segments: the investor services, the advisory services, and the commercial bank. And as of January 15th, the stock closed at a price of $28.45.
As my colleague John said, we are issuing a buy rating on Charles Schwab equity with a 12-month price target of $33.39. This represents a 17.4% upside on current equity value. We believe that Charles Schwab's continued financial innovation and the wide moats that they possess will allow them to grow the revenues at 11.1% average growth rate and attain a 10.9% average return on invested capital until 2020.
The first point on our investment thesis is Charles Schwab's innovation and growth. An example of this is the mobile application, which fully integrates real-time trading quotes along with their savings and checkings and ability to trade. And since it was the first, it really highlights their ability to innovate.
And whether it be changing the discount brokerage model in the 1980s or introducing the first supermarket of mutual funds almost a decade ago, Charles Schwab has proved to be a disruptor in the financial services industry. And now CEO Walt Bettinger has planned to do it again in the 401k market. And just to give you an overview of the market, the size is $3.7 trillion in size, and Schwab ranks 13th in size at $115 billion, with industry leader Fidelity at $1.1 trillion. And currently, 84% of the funds in the market are active funds, while Schwab is offering a passive approach, which will be 90% cheaper than all the funds out there, costing around 40 basis points. And we truly believe that this will be a significant catalyst moving forward. And actually, just last year, Schwab added 50 new, what they consider large businesses to their 401k platform.
Another innovation that Schwab has recently rolled out is their robo-advisor service. Basically what this does is it's a do-it-yourself platform that combines the asset allocation algorithms of the computer with the customization and flexibility of a human broker. And this is mainly an untapped market due to millennials coming into the investment space wanting to control their own finances. Currently, the fund has $14 billion, and we've projected an 84% CAGR to $255 billion in 2019, also adding 27 cents to 2019's EPS.
As Schwab is a financials company, we decided to analyze how approaching rate hikes might affect operations. Our research showed us that Schwab is much more than a rate play, and that the company remains the most levered and sensitive to rates of its peers, which makes impending rate hikes a juicy bonus on top of its other qualities. As short-term interest rates increase, we will see a commensurate increase in net interest margin, as you can see from the graph on the left. Based on management's guidance and Eurodollar forward rates to gauge when interest rates will normalize, we can conjecture that net interest revenue will grow to the following figures in 2015, 2016, and 2017. However, despite these figures, rate hike timing is not as important as many might think. This graph shows three different rate hike scenarios and their respective effects on net interest revenue. As you can see, the divergence is not very pronounced, and if the graph was extended out 5 years, you would see these numbers converge. The interest rate timetable only changes the time in which it takes Schwab to get back to its long-run growth rate, but does not change the growth rate itself.
Charles Schwab received a buy recommendation due to its wide economic moats. One of the economic moats is high switching costs. This is because for asset managers, it is exceedingly difficult to transfer all of their accounts due to the full integration of Schwab's different platforms. Currently, Schwab has 26% of the RIA business compared to 12% for its nearest competitor, Fidelity. This allows Schwab to reach more of its clients.
Another strong competitive advantage that Schwab has is their brand equity. And aside from combining that with their switching costs, what we decided to do is go out into the market, the Denver money managers, and do some primary research. So what we did is we saw whether or not these money managers were using Schwab and whether or not they liked using those products. And what we found was a very positive response. Up on the screen to your left, David Halseth, who runs Strategies LLC, which is a $3.5 billion money management fund. The technology has made us more efficient and better able to serve our clients. And what we found was these money managers like Schwab because, one, the brand name is so strong, and two, the quality of the products they really enjoyed.
Now jumping into the financial analysis of the company. On the top line, we've projected out an 11.1% CAGR. And just in the fourth quarter, the last week, Schwab announced an 11% growth rate in line with our projections. And we see this mostly coming from increased market share in the asset management business, as well as just general global AUM growth. Continuing on that, you can see Schwab versus their competition in asset management growth over the last 7 years, and they've averaged 13% CAGR in AUM growth. And we believe this will be sustained mainly due to the fact that they can continue to gain new client accounts at a pretty rapid rate. On the expense side, management is guided that once interest rates normalize, they'll increase capital expenditures. We believe capital expenditures will be used to open up new branches across the U.S. Currently, Schwab has 70% of their wealthy clients with $250,000 or more in assets close to a branch. Management would like to see that go to 100%.
So for those of you that do not know, a football field analysis is used to illustrate kind of the value of range of values that are implied by various valuation methods. As you can see, it also compares them to the dotted black line, which is the current price of Charles Schwab equity. We use this to observe the sensitivity of implied values for our several different valuation methods. And we used the three that we actually put up there were our trading comparables, some of the parts analysis, and our DCF method. Onto our comparables companies analysis, we wanted to include a wide range of companies that actually encompassed the three main distinct business segments of Charles Schwab, which are banking, asset management, and their commission-based trading. So you can see the asset manager BlackRock, the two banks JP Morgan and Wells Fargo, TD Ameritrade and E-Trade. After some review, we realized that these banks might not be the best to put in the comps analysis because of their their kind of inherent valuations. They actually drag down both the price to book and the next 12 months price to earnings, which we used. So we created a modified and more appropriate version of these comps using BlackRock, TD Ameritrade, and E-Trade, which yielded a price target of approximately $27 compared to the $20 from this set. For further sensitivity analysis, please refer to Appendix P, where you'll see our DCF sensitivity analysis. Now we finally go to our weighted equity valuation. We thought it would be most appropriate to use several valuation methods in our final equity valuation. As you can see, because they are the most detailed and comprehensive methods we used, our DCF perpetuity growth and exit multiple methods both garnered 25% of the weight. We used next 12 months price to earnings and price to book, the averages from our comp set, which both had 10% weight for a combination of 20% weight, and then our spread valuation and some of the parts valuation, which can be seen in Appendix F and G, both garnered 15% weight.
Now we're going to dive into our risk analysis for Charles Schwab. We believe that Charles Schwab is situated very favorably with regards to credit risk. This is due to their safe portfolio, mainly consisting of HELOCs, primary mortgages, and they are further taking steps to mitigate this risk, such as use of collateral to offset potential losses and careful monitoring of all loans. This has allowed them to achieve a non-performing assets rate of 0.04%.
Another risk that we wanted to cover was the regulatory risk. And a few things that Schwab can do to mitigate those is keeping an 8% Tier 1 capital adequacy ratio. Currently, they're at 9%, and that is double what Basel III requires. Also, monitoring any changes to the Dodd-Frank Act or the Volcker Rule. With the new Congress being recently sworn in, there's been speculation about that going into that and changing the policy. So it hasn't affected the company thus far, but keeping a close eye on it will mitigate any problems.
So again, interest rate risk is inherent in Charles Schwab's business model. However, we feel like the value of the firm is based on a commitment to growing the core business instead of short-term gains on net interest revenue from rate hikes.
So to reiterate, we recommend a buy with a 33.39 one-year price target and a 17.4% potential upside. We believe that this company is going to continue appreciating in value because of their continued innovation and growth, their resiliency to the economic environment, and their wide economic moats. Charles Schwab, a company constantly pushing for innovation in an industry that can at times be stuck in the past. Thank you for your time.
In your analysis, you talked about switching costs as an advantage. Probably the case related to advisor services business. How is the firm still customer services? Does that business have the same advantage just for technology?
We believe that for the investor services, it's not as difficult, but a lot of the money is coming from more of the investment advisor side of the business, which is larger with their accounts, which is allowing us to grow our asset management.
And also to touch on that, when we did do our primary research, one of the things that we were constantly told by these money managers is that it is hard to change in the investor services, and that, you know, once they have Schwab, they want to keep Schwab and they want to use the other services because it's like Apple. You constantly use all of their products and they integrate perfectly. So they really enjoy that aspect of it.
Actually, on the retail side, so like we talked to a few people who just use Schwab just for the banking arm. So I think E-Trade's the actually only other competitor that has a bank, and that's a big hit to a lot of people, especially with a lot of the fees that they were just pretty attractive.
84% compound annual growth in robo accounts, like their assets. What does that do to their other, the investment advisory and the two other businesses?
Absolutely. So what it does is we don't believe that it'll change the other businesses a lot. We want to focus on that untapped market, those millennials who are coming into the marketplace and saying, I want a professional advisor to help me, but I want to control my own finances. And an 84% CAGR going up to that $255 billion valuation in 2019 may seem like a lot, but it is only a small fraction of the $5 trillion in assets that human brokers are currently using.
And we think the clients are going for won't cannibalize the other business as well.
So no impact on margins because
It'll be marginal at best, I think.
Can you discuss margins going forward? You would discuss, for example, 401ks, a lower margin business, robo-advisors. How do you see those affecting overall margins for the company over the next few years?
Yeah, so in our projections, we actually narrowed margins going into the future, and the main kind of driver of that was compensation based to stock-based compensation plans, stock options, things like that. We also had them controlling at other types of expenses, rents, depreciation, these types of things, because they have in the past and they've been very, very great at that. But we also actually narrowed overall margins and increased compensation actually significantly as a line item to compensate for some of the lower margin business that they're going to be doing. I know that I'm talking about net margin, but also just from a gross margin perspective, we also narrowed that down. Basically, we took the yields that they're getting right now from each of theirs. So we went line by line in our revenue projection model and actually took kind of the yields that they're getting from every single service. So that is reflected, the lower margins. So the growth that's coming from the 401k market, it's incorporating those margins that it's getting into the gross profit line. If that answers your question.
The evaluation on some draws, can you go a little bit?
Yeah, absolutely. So that can be kind of, there's not really much explanation on the appendix about it. Basically what we did was we took the current EV to revenue multiples associated with segments of Charles Schwab, and we prorated kind of their growth ratings associated with them, and then readjusted it for our projections of growth, and then kind of reassigned EV to revenue multiples based on our projections. So you'll see that asset management as the highest growth segment that we're projecting is going to garner the biggest multiple, and then commission trading is actually at the lowest multiple, as we have it projected to be pretty flat through 2020. And then obviously once we have our EV to revenue multiples, we added those or some of those to get enterprise value, and then just did the traditional enterprise value to equity value valuation.
Did you do any kind of sensitivity analysis for the interest rates? What kind of impact would that have on EPS?
Absolutely, yeah. So basically, again, it's not in our appendix, but we have actually, we modeled out, is it in our?
Is that in your slides?
Kind of, but the actual effect of the EPS wasn't on the slides. So basically, we made our model and we toyed with it and did a sensitivity analysis for the rates being delayed 1 year, 2 years, 3 years, and 4 years. And actually what we saw was with the final value equity valuation that it didn't change. It was within 8% from 1 year being delayed all the way to 4 years being delayed. So it's just those cash flows that are in those years that are being kind of reduced, but the terminal value I think made up 65% of the final value, because we're projecting that by the time horizon value is realized that rates will normalize. And we've seen these cycles again before in the past, so we're assuming that by the time horizon value hits, that rates will be normalized. And so to answer your question, I guess in a short form, EPS was not, and equity valuation was not significantly affected by delays in rate hikes.
Is that offset because the fee waivers kind of offset some of that impact, or why? I would think that'd be a material
It was within 8%, so it was somewhat material. But again, it only affected the cash flows from each specific year, and so compared to the actual horizon value, a few specific years of cash flows didn't do too much to the actual valuation, because you're looking at about 30% of the entire equity valuation there.
And then also, we're talking about right now differences in years for interest rates. It seems very likely that we might be looking at differences in quarters or differences in half years. And so when we also did a diagram of that in one of our appendix slides, looking at how that changes it, and it's even smaller.
What was the most interesting part of the analysis that you did, or maybe the most challenging?
I can touch on that. I think one of the most interesting parts was actually doing the primary research. You can go and you can do all this analysis, and you can read about Schwab and all of the different things that they're rolling out or what interest rates will do, but actually going out and talking to the money managers, seeing what they felt was the most important aspect of Schwab services to their business was huge. So, for example, I worked at a wealth management firm this past summer, and we used Schwab as a custodian. And so I saw it all summer, kind of looking at that part of the business and seeing how that affected the company, and then going and talking to those money managers and having them explain to us, how that worked and why it was such a value add to their business really helped us tie it into this presentation.
You're a believer.
Yeah.
I think naturally with a financial services company, the most difficult part is understanding how you guys actually make money and understanding the business model in general. So just throughout the process, going to the management presentation and doing more research on ourselves, I think that was very rewarding. That's just because it was so challenging to understand the business model.
You're forecasting increase in market share and consistent 11% compound annual growth in revenues. What drives that?
So basically what drives that in the model, we have a report from PwC that actually projects global and domestic AUM throughout, I believe, 2022. And so basically we took, as Charles Schwab's very domestically focused, we took the domestic growth rates on that, and then basically had that as our global AUM, took the current market share, kind of current yield we're getting on the entire market, and then kind of adjusted that based on kind of the market share that we believe that Schwab will be taking in the future. And we also wanted to kind of back test that and make sure that we were being reasonable and make sure that Charles Schwab was able to attain this type of growth in the past. And we have numbers right here that from 05 to 07, during kind of an economic upswing, Charles Schwab was actually able to attain close to an 18% year-over-year revenue growth rate. And so I think through that back testing, we saw that 11.1% was very, very reasonable number to use. Because of course, 11 double-digit growth for average over 8 years seems very, very aggressive, but kind of back testing it and making sure it was a reasonable number, we kind of decided that was a good way to do things.
We have time for one more question. Judges have another question.
You mentioned a lot of this positive things going on as well. What's the biggest challenge?
I guess I can touch on that first, and I'm sure
I can jump in as well.
Yeah, I would say just the biggest challenge, at least from pitching it as a buy, is probably its valuation. It's trading at premium multiples, and although we've obviously argued that it's well deserving of these multiples, I still think just from, if you're a value investor, it's very hard, and just only a deep value investor, it's hard to look at this company and just say yes, because it does have the multiple problems. But obviously after researching it more, and that was originally kind of a speed bump for us, we were like, how are we going to just as a buy? But after looking at the company in more detail, we were able to see that it is indeed an attractive company.
And then I think a secondary problem might be the competition within the asset management business. We didn't have a whole lot of information on Fidelity and Vanguard for obvious reasons, but what's to say Fidelity doesn't cut their rates from 50 basis points to 70 just like Schwab. But we think just because of the nature of their customers being very sticky, we don't think that's a huge problem.
Great, thank you.
we would just like to thank the judges for coming out. We really appreciate it. We would also like to thank the CFA Society as well as Charles Schwab. Something we'd like to disclose up front is that we are actually current customers of Schwab. We're all members of a portfolio management team at our university, and we actually use Schwab to make our trades. That being said, we're from the University of Northern Colorado. My name is Jenna.
I'm Joseph.
I'm Dalton.
And I'm Michelle. I'm going to begin with the company overview. Schwab has a business model comprised of three main areas, which is their security brokerage, their individualized portfolio management, and banking. We've included a market profile as of January 15th. On that day, their stock was trading at a price of $26.78. Through our analysis, we recommend a buy with a target price of $32.36, offering 14.9% upside potential. We have several key drivers, with our two main ones being an increasing interest rate environment as well as the economic expansion in the U.S. We predict that the Fed is going to raise short-term interest rates in the early to mid stages of the third quarter. When Charles Schwab founded the company in 1971, he had a company strategy which included a combination of low prices as well as fast order executions. Today, Schwab has several different strategies, a couple of them which are preparing for the next generation of clients, as well as innovative price and product development. These company strategies are built on Schwab's outlook on the economy. They are predicting that there's going to be an increasing trend in equity, as well as a movement towards more risky investments. They also believe that with the decreasing unemployment rate, there's going to be a spark in consumer confidence. However, they will continue to diversify internationally. The foundation of this company is found in its corporate governance. Charles Schwab has currently 12 members on its board of directors, with only 10 of them serving on committees. Charles Schwab and Walter Bettinger, the CEO, are both on the board, but neither of them have voting rights. Also, each member of the board has an investment in the company. I'm now going to introduce the industry and its competitors with the Porter's 5-Force model. The investment brokerage industry is in its early maturity stages of its industry life cycle. For this reason, we see that there is a lot of competition within the industry, as there are a few key competitors who have already saturated the market. We also see that there is relatively high bargaining power of the customer as they can move from one company to another relatively easily. Now I'm going to turn it over to Joe, who's going to talk about interest rates.
All right, thanks, Jenna. So interest rates are a really integral part of the financial industry. I know the Fed fund rate has been at 0.25% since 2009, and this is reflected within the 10-year Treasury yield in the past year. We do predict that short-term interest rates will rise within the third quarter of this year, which will lead to larger margins in the financial industry. This will also be a key driver for the economy. So Schwab, most of their profits do come from the clients that they have. The more clients that they do have, the more profits that they do gain. As we can see over the past 5 years, for total client assets, it has increased tremendously compared to its competitors over the last 5 years. And as the year goes on, we hope that investors will be less risk averse and more willing to go to the markets, where this will be an opportunity for Charles Schwab. The competitive positioning is very, very capable. They do have their online and mobile points where clients can reach out to them. Although they don't have as many branches as their competitors, they do have a 24/7 phone service, which they can go ahead and clients can reach out to them. They do have a flatline fee structure, which makes it very easy for clients to go ahead and take a look, such as ETF One Source. And they have a high quality research that's really easily understood, as we do know since we do use them. And so we'll go ahead and move on to our financial analysis. And net interest income is just one of the three parts that goes ahead and creates the revenue structure. It has been increasing over the past 5 years, both numerically and as it being a part of the revenue structure. And this is through the equities that they have gone ahead and Schwab has been invested in, and the loans that they have been issuing. Although with an increase of loan, there is also potential for bad loans to come about, so that's something to keep in mind. The other two parts are the trading and principal transactions and asset management fees. Over the past 5 years, the trading and principal transactions have become less of a piece of the pie for the revenue structure, but it has remained numerically the same. While we see asset management fees have gone ahead and increased over the 4 years, the larger client base that Charles Schwab has been gaining. For a ratio analysis, we went ahead and comprised our own weighted index with Ameriprise Financial, E-Trade, TD Ameritrade, and Goldman Sachs. I'd just like to draw your attention to the PE ratio, which is or the PE earnings is at 29.43, which means that they do have a lot of potential for growth, and also that their asset growth is at 17%,
which we do use in our valuation, and the net income growth is at 10%, which is about 5.5% larger than our weighted index that we went ahead and created. So we can pass it on to Dalton to go ahead and speak about our valuation.
Thanks, Joe. Just to start off, I'd like to say that we use two valuation methods. We use the free cash flow method and the relative method. We decided to leave out the dividend discount model because our dividends haven't been growing, and we don't believe that that would have accurately reflected their price. They've been plowing, and without that increasing dividend, they've been plowing a lot of their earnings back into growth. Some of the main drivers for growth we have are advanced technological platforms such as the ETF OneSource and intelligence platform. These are just ways that invest in instruments that the clients can use for a streamlined investment process. Next, we have the aging population. We believe that the United States has the perfect demographic for investments. Baby boomers are beginning to leave the workforce, and they're going to need to generate a lot of passive income. And we also believe that the average free cash flow for the American is going to be increasing that they can use in investing. This is our relative valuation. All these numbers were pulled directly from Morningstar, except for the ones highlighted in blue. We used a PE, a price to book, and a price to sales. The PE, the estimated EPS, and the estimated price to book, we slightly elevated compared to analysts because we believe that their earnings are going to be increasing with those drivers for growth. And the price to book, they're selling off a lot of their branches and fixed assets, so that's going to decrease that lower value and raise their estimated price to book. For price to sales, we kept it relatively similar to analysts' estimates and the 5-year average. This is our free cash flow model. We decided to use just a one-stage free cash flow model. So we grow at 1 year at 17.65%. This is based on an average of their 4-year asset management growth, so the assets that that Schwab is managing, and then 7% from there on. The sustainable growth rate we have is 7%. This is relatively high, but we feel confident in this number because of how the financial industry is staged to continue to generate revenues later on. This brings us to a target value of $32.36. We decided just to take a simple average of all of our valuation methods without over or underrating any particular one. Next, I'll hand it on to Michelle for risk analysis and conclusion.
Thank you, Dalton. So as with any other financial services company, Schwab is highly dependent on market conditions both domestically and internationally. The potential for growth is reliant on the assumption that interest rates will be rising this year. As a group, we are very confident in the fact that interest rates will be rising. However, a delay in this rise will keep net income low for the beginning of this year. Obviously, there's volatility in the market. However, we believe that the long term will be positive and that investor risk aversion is decreasing. Another thing to take a look at is any government regulations that are being put into place. The Dodd-Frank Act was put into place a couple of years ago. However, Congress seems indecisive on whether or not these regulations will stick, and if so, how strict they will be on enforcing them. Any government regulations are going to have an effect on all financial companies and not just Schwab. Another risk to take into consideration is the amount of trading volume. As you can see from 2013 to 2014, it increased drastically, and we believe that the drivers for this are both consumer and investor confidence. And we believe that with the predicted rise in interest rates, that both of these factors are going to increase, also increasing trading volume. So to investors, we recommend a buy. With a $32.36 12-month target price, this will give investors an upside potential of 14.9%. With the continuous introduction of various investing technologies such as Street Smart Edge and the ETF OneSource, which completely individualizes trading and eliminates the third party, we believe this will give Schwab clients more investing confidence. Also, with the improving economy and with our predicted rise in interest rates, we believe that this gave us confidence in our recommended buy. Schwab has strong performance relative to its peers, and which gives it a competitive advantage. And with the baby boomers generation coming to an end, we believe that this is an excellent opportunity for growth in retirement planning and young new investors. These are the main drivers that led us to our buy recommendation. We are confident in our research, and we welcome any questions that you may have.
On the relative valuations, were you using forward PEs?
Yeah, estimated PEs for a 1-year target price.
Right, and they were forward PEs. These historical numbers were forward.
Yeah, our estimated, but then we have our current and then our 5-year averages.
And the inclusion of Goldman Sachs in the peer group, how does Goldman Sachs fit into the peer group?
So we do realize it's larger and it's got a larger market cap, and then there's slightly more relative to it. But we had E-Trade in there, and we saw that E-Trade was such a smaller company compared to Charles Schwab, so we did put it in there, but we weighted it at 10%, while TD Ameritrade we felt like was a very good, strong competitor, so we weighted that at 40%.
You talked a lot about interest rates. Could you do that on valuation of this? How do you interest rates come into play? And the second part of that is that if you don't have new interest rates, how does that impact your valuations?
Well, it would probably wouldn't affect our valuations that much because we have interest rates moving just slightly within the third quarter of this year. So we kept it very conservative as far as our growth rates. I think the average asset management growth we found to be just around 17%, maybe 16.9%. So we were very conservative on our growth. So I don't think it would affect our valuation that much.
Schwab doing relative to the competition in order to distinguish themselves and get market share justifies the growth.
I think there are a lot of factors that play into that. I think the first mover advantage with the 24/7 investment advice was a huge thing that distinguishes Charles Schwab. I also think that the easiness of being able to trade and the low fees also play into that.
So you'd really emphasize the retail operations. Could you expand a little bit more on the banking segment, how that was reflected in the analysis and the valuation?
To be honest, we didn't put that into the valuation as much as or that heavily. I can definitely get back to you on that, but I would say that it wouldn't affect it too much just because it is such a small portion of their business. But we do believe that it would perform better because of the rising interest rates. They're going to increase their profit margins.
So the three parts of Schwab that make up is their investment side, their advising side, and the banking industry. When we're taking a look, we saw most of the revenues coming from their investment and advising. And we did take a look at their NY through the banking part and saw that they were increasing in loans slightly, but it wasn't much of a justification that we felt to go ahead and go fully do more research.
We've got revenues growing, and I get that it goes along with assets under management and that. The cash flows have been a whole lot more volatile. How is it that you have cash flows growing so steadily in your free cash flow model?
I didn't look too heavily into cash flows. We looked more into revenues and then just the size of the amount of assets they were managing. Because we thought that would directly correlate into their revenue growth.
And that's why we did a single stage model, because when we actually looked at the 5 years, it was really hard to, justify how they were going to grow it at that rate. So we kept it at our single stage model just for future cash flow.
Looking at the full valuation of this thing, there's three dimensional valuations that are just on us. Looked at one drops, dry a lot more on that one.
We didn't feel comfortable over or underweighting any of them, so we just wanted to take a simple average. We understand that the free cash flow is higher, but all the other ones are definitely higher than their stock price currently.
Is there any one distinction thing about the company that you think is a plan? What do you think it is that you found in your research or analysis that stands out to you, good or bad?
I would say something that we found that we really liked about Schwab is that they just have such a good reputation, that they're really well known. All the advertisements of "Are you asking the right questions?" And especially in the investments world, there's a lot of kind of mistrust that you don't necessarily trust your company. But we feel that Schwab has that very good company image with their 24-hour services. They are just very well known for their customer service, as well as they're continuously trying to improve ways to take out that middleman to make it easier for the common investor.
Also, with new investors, I think the nice thing about Schwab is that you have the option of having someone helping you in making your first investment decisions, or you can do it completely on your own, and that's kind of the advantage of the individualized trading that Schwab offers. I think that it offers both for expert investors and new investors.
Do you see a trend either way toward more advising or less advising, and the impact of that on their margins going forward?
I don't believe we did much research on that, but I believe that their revenues for asset management have been going up, and so I think that definitely plays into it.
Do you think they've been doing a good job in a tough interest rate environment, and how is that, have they been doing a good job given a tough environment, and how will that look going forward?
Yeah, I definitely think so. I mean, over the past 5 years, their total client assets have gone ahead and increased, and interest rates have been really tough, but they've still been managed to go ahead and increase their total client assets. So their clients do believe in them, and they're putting more money towards it.
But as it's reflected in net interest income?
Net interest income. Remember, see if we do have the net interest income on here. But that's just the revenue. Yeah. So with reflected in there, so can you just rephrase your question? I'm not understanding it.
They've done a great job with the asset management
Okay.
overall, I guess that's the impression I'm getting. But in terms of managing the net interest income in a tough environment, are they doing a good job there, or is there a lot of room for improvement?
Oh, okay. So I think they're doing good there, because it has been, as we looked at it on our, it's actually on this one, their net interest income has been growing larger, the whole revenue structure. And so when we look at back, the net interest has been decreasing, as we can see through, through the 4.4 and 4.7, it's actually been decreasing. And then, when we actually look at the numbers, they have been right around, and even their interest expense has been decreasing.
I also believe that number that margin will increase as interest rates rise, because they'll be able to it won't be so tight as far as what they're charging and then what they're making.
Is there a decrease in interest expense been due to a smaller debt load or lower interest rates?
I don't believe we looked too close into that. We didn't actually see what the drivers were. We just kind of took the number of value as it was. So unfortunately, our research didn't bring us that far. But we can definitely get back to it.
Is the company doing anything to hedge the profitability of the case of the market downturn?
Once again, I'm not sure on that. I can speak to it. I believe that I personally think that the interest with the drivers for growth and the interest rates increasing, there might be a market pullback, but I think the financial sector in general is staged really well for a lot of really good growth, and that's reflected in our valuations.
We have time for one more question if the judges choose.
But as far as specifics, I can't speak.
The relative PE is strong relative to their peers. What do you think is driving that, and do you see it continuing?
I mean, just the potential growth that's there, and that we see that there's just so much growth that's available, and that's calculated within their PE. I mean, with their ETF one source and their intelligence platform that they just came out, and then just their outlook on the economy, I think it really reflects within their PE ratio, and that's why they have more room for growth than their competitors.
All right, thank you.
Hello, I'd like to thank you all for being here with the Metropolitan State University of Denver. I'm William Hernandez, and joining me are Nate Goff, Teresa Mayu, and Christy Tuttle. Today we'd like to present our valuation of Charles Schwab Corporation by issuing a buy recommendation with an intrinsic value of $41.54 with a 38% upside to the December 31st, 2014 price of $30.19 using a discounted free cash flow to equity model. We believe Schwab's revenues will continue to grow through its sound and diverse business model, and revenues from net interest margin and asset management fees should see a substantial boost once interest rates begin to rise. Additionally, Schwab's disciplined approach to expenses should see its revenues rise proportionally higher than costs, in turn bumping up pre-tax profit margins. Though Schwab's business segments are largely tied to general economic conditions and market levels, we see the firm able to capitalize on various economic cycles through its diverse set of offerings. Using a top-down approach, we also see we hold an optimistic outlook towards the global and local economy, and as well as the financial sector in general. Using this outlook, along with Schwab's strong financial positioning, we see it will help the firm maintain its competitive positioning within the market and along with its peers. To cement our position further, I'd like to turn it over to Nate to talk about our economic outlook.
Thank you, Will. The main macroeconomic drivers for Charles Schwab are U.S. interest rates, equity valuations, and the overall general economy. However, these drivers are contingent on U.S. and world economic growth. We forecast continued gains for global stocks in 2015. These gains are supported by central bank stimulus and monetary. These gains are supported by central bank stimulus and global fiscal policies. The European Central Bank's new quantitative easing, the Bank of Japan's own QE program, and China's continued credit easing will all ultimately lead to economic growth. Similarly, as then Ben Bernanke, Fed chairman, in 2013, said in a speech in March 2013, these policies are not big or thy neighbor. Rather, it is a positive sum. Enrich thy neighbor. Rather, as a positive sum, enrich thy neighbor activities. Furthermore, Europe's reduced austerity, Japan's delay of the consumption tax increase, and China's continued fiscal stimulus programs will further induce growth and drive up asset prices in the U.S. and around the world. Stimulative policies around the world, coupled with the U.S. conclusion of monetary easing, has led to a stronger dollar. The stronger dollar will temporarily move inflation from the Fed's objective 2% increase in an annual 2% increase in annual prices and annual increases of consumer prices. The correlation of a strong dollar and stocks in a positive territory are resembling a bull market in the 1990s. The recent 50% drop in oil prices has created downward pressure on inflation. The reduced energy prices will provide real income growth for world oil importers. This will provide further stimulus and economic growth and benefit the U.S. economy and market. However, inflation historically leads increased equity valuation. The energy sector's weight in the S&P 500 and the S&P 500 PE ratios ultimately have a negative inverse correlation. The lower weight of the energy sector in the S&P leads to a higher PE ratio of S&P firms. Consumer spending, consisting of 68% of the overall economy, grew to 3.2% rate in the third quarter of 2014. However, most importantly, consumer services increased by 2.5% yearly for the quarter. Consumer free cash flow is increasing due to decreased oil prices and are driving consumer spending and income growth. Consumer confidence grew to 102.9, a mark not met since August 2007. Capacity utilization is currently 79.7%, nearing the critical level of 80%, indicating high demand for expansion, investment. And finally, unemployment at 5.6% is the lowest level it's been in almost 7 years. Lastly, GDP growth has grown at a rate of 3.5% for 4 out of the last 5 quarters. All this ultimately will lead to equity appreciation. Schwab's profitability has been restrained by the low interest rate environment. Schwab's market interest revenue accounts for more than 30% of overall revenue. This is all directly driven by lower interest rates. We believe the U.S. economy's strong performance, coupled with the strengthening dollar and consumer confidence, will lead the Fed to raise rates. However, we believe the sustained low inflation due to low oil prices will ultimately push the rate increase into the first quarter of 2016. Low rates for a little while longer is good for growth, good for stocks, and ultimately good for Charles Schwab.
We incorporated these drivers into a free cash flow to equity valuation model. This model was selected and is more direct than free cash flow to the firm, and Charles Schwab's capital structure is relatively stable. We did not use a dividend discount model since Charles Schwab dividend per share has remained flat for the last 5 years and does not correspond to their change in earnings. We also explored multiples analysis, however, found it difficult to find a competitor with a similar business structure. So we ultimately decided that free cash flow to equity was the best, most robust model. We projected the income statement by assuming that net asset revenues would continue at about 35% of total revenues, while asset management fees increased from about 42% to 50% of total revenues, and trading revenues became a smaller piece of the business, shrinking from about 15 to 10%. Continuing to increase client assets provides a steadier stream of revenue for the company and allows more competitive pricing than trading. Under the assumption that the Fed funds rate would increase to a target range of 25 to 50 basis points at the beginning of 2016 and subsequently increase at 25 basis points every 2 quarters, we added back 75% of fee waivers into 2016 revenues. Beginning in 2017, we eliminated fee waivers altogether. This increase in interest rates also incrementally increases net interest margin at an impressive rate of about 60 basis points per 100 basis point increase. The balance sheet was projected using a percentage of sales approach and assuming that capital structure would remain fairly stagnant at 77 to 80% of equity and 20 to 23% long-term debt and preferred stock. Cash flows were discounted, assuming a half-year convention and a cost of equity of 12.5%. Using this, we arrived at an intrinsic value of $41.54. Chrissy will now discuss the key risks.
Thank you, Teresa. Though there are several risk factors that exist within Schwab, we did find a couple key factors that may potentially impact our valuation. The main risk that we see for Schwab over the short term is a subdued low interest rate environment. Last year, we estimate that Schwab had to lose around $800 million in revenues due to money fund waivers. However, based on our analysis and discussions with the company, we found that once rates rise beyond 55 to 75 basis points, Schwab can start eliminating those waivers altogether. We do believe that rates will start to rise in 2016, and once that happens, we can probably expect around $600 million in incremental growth to the pre-tax profit for Schwab. Despite this risk and increased regulation, we do believe that favorable macroeconomic conditions, coupled with strong company performance and stable growth, as well as imminent interest rate rises, will push our stock price closer to the projected intrinsic value of $41.54, meaning that it's undervalued and it's definitely a strong buy. Thank you for your attention. We'll now turn it to the judges for questions.
Your methodology of evaluation, do you do an analysis
of we did push out the increase to the beginning of 2017, and that didn't decrease our intrinsic value by about 15%. So it is sensitive to when that happens and if that happens. So in a prolonged flat environment, that could hurt growth.
You talked a lot about the external and macro sort of factors impacting the stock. What about management? What is management doing positively or negatively to affect the stock price?
So far, I mean, they've had a pretty good team leading for a good amount of years now, and we don't see why management would have any sort of drastic effect over whether or not it would change our valuation. We think they've been doing a good job, and we see that they will continue to do a good job, so we don't necessarily see that being a problem.
Just to tag on to what Will said, the company has also seen strong year-over-year growth in client assets. I believe it's at around 10%. In addition to that, they've also done an impressive job keeping their expenses down. We did have a hard time finding competitors for Schwab just because we couldn't find a company with the same sort of revenue structure. But Schwab's expense ratio is around 16 basis points, and some of their competitors are 4 times that at around 64 basis points. So I think that gives them an edge over the competition.
Are there industry trends that are looking for or against Schwab? See that get you for growth and
I believe the industry trends of basically diversifying. I mean, Charles Schwab started as your small brokerage firm is trying to become a full financial services firm. So diversification, and they've also incorporated the mobile platform, which will ultimately reach towards the younger generation who they need to incorporate, within their structure, especially once the baby boomers transition to more fixed income assets, and there's less opportunity for sweep and things and such.
portfolio diversification?
Well, diversification in their client base and client asset base. And also, I believe just their diversification in general, their acquisitions that they're making, their options trading, Windhaven, Option Express. So I believe, they're making wise choices ultimately, and Mr. Bettinger and Mr. Marionetto are leading the company quite well.
Can you expand on your valuation method? You had mentioned that you used free cash flow to equity. That was preferable to any of the other methods, including free cash flow to the firm. Can you expand on why?
With the financial service company, from the research we did, it sounded like it's more difficult to kind of separate debt efficiently to use WACC. So we decided that using the cost of equity would be more direct and kind of take out some of that guesswork and minimize the assumptions as much as possible. So that's why we chose to go with that method.
Do you see any headwinds or tailwinds in terms of the shift from discount brokerage to more asset management?
I would say that the tailwinds are ultimately just that they continue to grow their client base. The headwinds will most likely be just competing with the main financial services firms that are already established in the industry. However, Charles Schwab's conservative nature and their continued growth of client assets ultimately will serve them well. They've, for every 10% increase in client assets, they turn that into 11% in revenues. So, and they've done that for 3 years straight. So I believe they're well positioned using that as a tailwind, and the only headwinds most likely will affect all firms in the industry.
Oh, that's unusual. The premium TE, what drives that?
I would say that they're, from what I've looked at competitively, they're one of the highest at around 32. So I see that as incorporating the potential. Everyone sees the company with so much potential. It's that coiled spring that's ready to expand as soon as interest rates move, and they're incorporating that into it, and just see the potential for enormous growth and cash flow once that does happen. So I think that's where that premium comes from.
Just to tag on to that, I think that there's a lot of operating leverage just inherent in that business model. So I believe that once we do start to see those incremental revenues, most are going to fall to the pre-tax profit, which should drive a lot of growth in the future.
Do the judges have any other questions?
Thank you.
Thank you.
Thank you very much.
Good job. Good job.